am Deidre Quinn, and welcome to Pending and Trending, a podcast that started in real estate and grew into so much more. Here, we talk about the power of building wealth, creating opportunities, and designing a life that lasts for generations. With expert guests and real conversations, my mission is simple: to help you elevate your journey and build the legacy you deserve. Welcome back to Pending and Trending. Our guest today is Lauren Rogers. She is a partner at Veritas Equity Partners, a private real estate equity firm based in the Pacific Northwest, specifically the state of Washington. She is the asset manager at the firm, bringing a strong background in partner management, sales, and marketing from global tech companies. Lauren plays a key role in growing Veritas through disciplined investing, strong investor relationship, and a long-term strategic growth approach to multifamily real estate. So, Lauren, thank you so much for being on with us today. I'm so excited for the conversation.
Me as well. Yeah, thank you so much for having me. I'm excited to be here.
Great. So now I was looking, I know that you're the co-founder of Veritas Equity Partners, and I was really digging into what you do. And I noticed that one of the things that you stand for, you said that you left a successful sales tech career to answer one question. And that one question was, how do you turn years of W-2 income into wealth that lasts generations? And I think that's something that all of our listeners really want to do and have a dream of doing. So I would love to have you answer that question for us and start there if we can.
Absolutely. Happy to. Yes, that is the $1 million question, right? Pun intended. So I was in tech for over a decade. I started my career at a company called Tableau, which was acquired by Salesforce later on after I left. But I'm based in Seattle. I'm from the Seattle area. And so I went to Seattle Pacific for undergrad and grad school, and then just parlayed into tech because that's obviously a huge market here in Seattle. So it wasn't necessarily a super intentional decision, but it was a wonderful career. I went from Tableau to AWS, which is Amazon's cloud side of the business, and I was there for 7 years, which was a great learning experience. Took a lot of the leadership principles from Amazon and skills that I developed there into this business. But as I was getting farther and farther into my career, I was unsure if I wanted to keep climbing the corporate ladder. I was losing a little bit of its luster. And more importantly than that, I was compensated primarily in stock, or a big part of my compensation was RSUs, which is common for tech employees. And so in order to benefit from my stock options, you had to sell them, and then I was getting crushed in taxes. And I realized maybe a little later than I would have liked, hey, I'm making really great money, I have great income, but I don't think my investment strategy is working because I don't have any cash flow. And if I want to maybe transition into something else, I need to think about how I'm investing this. And that led me to real estate. I started listening to a lot of Bigger Pockets and drinking the Kool-Aid of real estate investing and hearing all the people on there that had done these incredible things and retired themselves. And I was like, wow, I want to do that, right? So I was talking to a friend at Amazon, and there was a gentleman that I did not know named Alex Birch. I was thinking about buying a duplex or fourplex, something like that, to get my foot in the door. And this person said, maybe you shouldn't do that because you don't know what you're doing, and you should talk to someone who does. And that was my introduction to Alex, who'd been buying apartment buildings on the side while also working in tech sales at the same company, even though we didn't know each other. And so I met with him. And long story short, he was at a point in his journey where people were asking to get in on deals, and he had created financial freedom for himself and was wanting to start going down the path of raising money. And I have a great network from my career in tech, a lot of high earners that were in a very similar position to me, going, I have money, but I don't have cash flow, and I'm getting hit with taxes, and I need a different strategy. So my role initially was to raise capital from my network, and started Veritas with Alex, I think 2.5 years ago. We founded the company, and then we did our first deal about coming right up on 2 years now.
Wow, congratulations.
Thank you.
Now, what a great story. So now, do you help other people achieve that now as well? Is that the goal of what your company does?
That is, yeah. So we raise capital from other investors. Obviously, we use our own capital as well, but when you're working with only your own capital, you can only go so fast. And we were getting access to a lot of deals that were really great that we were having to turn down. And so that was the reason for wanting to take this to other people. As I was like, hey, I've seen what Alex has done and the wealth that he was able to build. I want to help replicate that, help my friends and people in similar situations to me diversify their portfolio and get into real estate, because there's a lot of people that either just don't want to manage it themselves, and they're smart enough to realize, almost like me, where I was like, I'm not qualified, nor do I know that I want to take on managing my own assets without any knowledge of this space.
Right.
And yeah, that was the idea, is like, how do we make this passive for people who might not, for whatever reason, want to, or might not have enough money to go buy their own property. Maybe they want to put in 50,000 and try it out, or 100,000. They're not in a position to go spend their entire net worth on real estate. So how do we provide an option for that caliber of retail investor?
So, how do you find opportunities that minimize risk for people and maximize returns?
Yep. So I think the first thing is obviously buying at a good basis. So our whole shtick is Washington State, which is a supply constrained market with a strong economy, migration growth, really long history of rents increasing, and it's hard to buy a house here. So the fundamentals of our market, there are a lot of forever renters. Our tenants are median income. So we're not Section 8, but we're not A-class fancy stuff either. We're just middle of the road, bread and butter type of workforce housing, where most of our tenants are just not in a position to buy a home, because our median home price in most of the areas that we buy is around $1 million. And for someone making between 40 and 80K, that's really hard to achieve to get into a home. So they tend to be a really great tenant base. They take really good care of our property. They're forever renters, so they don't want evictions, and really responsible, hardworking people, and just providing them a well taken care of, nice place to live. So that's one thing, is we believe in our thesis, right? We know how to buy in this market. And then also the debt. We're very conservative in terms of how we underwrite. Like, we're not doing big rental increases. We're not banking on cap rate compression or anything crazy happening. We're just saying, does this deal pencil right now? Does it cash flow right now? So if nothing changed, we would preserve people's capital and grow it. Now, are we promising 20% returns every time? No. But we're also getting agency debts. We're putting 35% down, 7-10-year fixed debt. By nature of agency, we have to get a certain type of insurance policies that are very conservative. The government underwrites our buildings. They underwrite us as the operator in our experience. So these are very conservative buys. We don't do any construction. We don't do any permitting. So it's a pretty bread and butter type of real estate investing.
And then when can an investor, what's the turnaround on their return?
Yep, 5 years. We tell people 5-year hold. If we can do it faster, we will. If certain things shift in the market, it could be when we get into a building, we are immediately, before we even close on something, we're executing the business plan. So if people are way under market on rent, we're implementing rental increases, and sometimes those people move out, and then we're able to turn their units. Most of the time, the units in the buildings that we're buying, they might have not been redone in 30 years. When you buy workforce housing, it's a little funky, right? I didn't realize that these are not big new developments. So every single unit is very different. So you walk in and you say, okay, this unit hasn't been touched in 40 years. We're probably going to get the whole thing. Some other units, maybe they were partially redone 10 years ago. So it's a unique business plan in terms of what we're going to do to each unit. But as people start to move out, we we turn those units and then we bring them up to whatever that median rent is. And we don't need to, they're already 15% low at least on what that rent should be. So it's not a matter of saying we're banking on the market going up. We're saying, hey, right now, today, this building hasn't been well operationalized and rents are light. So if we turn this unit and make it nicer, often other people in the building will even just move into the new units. We'll send out a note and say, hey, if you want a new washer and dryer and appliances in a new building, just move over here. And so that often happens.
Okay. What are some common underwriting red flags that passive investors would overlook?
I think a big one is just what is fair rent, and that information is available to all LPs. There's a variety of tools where you can pull that, but like one is rentometer or rentometer. I'm not sure how exactly you say it, but you can go in and plug in the address of a building and it will pull up for you everything within however many mile radius you put in there. And you can click through all the buildings. You could go and look at them like some of our LPs do that. But at the very least, you can see, hey, what are the other buildings getting for rent? What do they look like? And you can just eyeball like, yeah, this building is the same as this building. And this building that's next door to the building that's being bought is getting higher rents. And it's exactly the same. So it will tell you, here's what median rent is, and you can at least get an idea of if you think that's fair all on your own, and you don't need to be a sophisticated underwriter in order to do that. So that's one thing. And then I would say big rental increases is another red flag. We do underwrite bigger increases year 1 and 2 because we are trying to turn these buildings relatively quickly. This isn't like house flipping, right? It's a 5-year thing because you don't just go in and make all your tenants move out, right? You renovate very slowly as they move out. So it's a slower process, but once we do, maybe depends on the building, but between 5 and 9% increase in those first 2 years to get everyone to where they should be, then we're doing a very slow drip and increasing 2 to 4% with the market. And so I think that's another thing is if you're looking at underwriting and they're saying, oh, we're going to go 5-6% every year, that's not, it depends on your market. Maybe certain markets are going up at that trajectory. I only underwrite for Washington, but that's probably not realistic. And then certain markets are actually going down, like markets that have a lot of supply. We're seeing what's happening in the Sun Belt right now. And that's because if you can always build a building right next to your building, they don't have the same value that something in Seattle has where there's no land and no permits and no places to live. Unfortunately, Washington is making it even harder for developers to build here. So they go to places like Texas where they can get permits faster and make more money.
Right. If someone's considering investing with you or a similar company, what questions should they ask before committing to giving the capital?
I think the biggest thing is how many times have you done this? I see other syndicators buying all over the country. I'm not personally a big fan of running other people's money in markets where you don't live. I think if I drive out to all my buildings almost every week, right? When something goes wrong, I'm there on site. I know my property managers. I know my crews. I'm there managing the unit turns. I think it's really hard to manage effectively at scale if you're buying all over the country, nor are you really an expert in what that market. We know our market down to the street, as would an operator who buys only in Houston or only in whatever your region is. I think that's important. I also think it's important to do one thing. I think I would personally be very nervous if someone was saying, I'm going to buy an old person's community and then an RV park and then multifamily and then self-storage. It's all real estate is very niche, and there is things that you learn at scale from doing any one thing. Maybe your thing is development, maybe your thing is self-storage, and you have a lot of learnings and scale mechanisms for doing those things. So I would say track record is really, I sense from people, that's what they're deciding on, even more so than the particular property I'm showing them. They're asking, how many times have you done this? Show me your past deals. What kind of returns did you get? What kind of mistakes have you made? How did you recover from them? And that's more important in my mind than a specific deal, because there are a lot of good deals out there. It's not like we're trying to find a needle in a haystack. There is enough deals where you can make good money if you know what you're doing, and that really comes down to operational experience and excellence. I think track record. And then the other thing that I mentioned is debt. I would only invest with someone doing agency loans. I think if someone's doing bridge debt, hard money, construction loans, that's how a lot of people are in trouble right now. So understanding the debt structure is equally important.
That's great, Lauren. So you mentioned mistakes and recovering from them. Can you give me as an example of a mistake and how you recovered from that?
Yeah, I mean, there's little ones and big ones, right? And sometimes something unforeseen. Recently, we bought a building, and typically when we're doing an inspection, so we have our own inspection, and then Freddie Fannie, if you do agency loans, they do their own inspection as well. And then insurance does an inspection. So we're getting 3 inspections. So it's pretty rare that we get blindsided by something, but one building we had the parking lot needed to be redone, and that didn't come out until later. It was like a year into owning it that we realized it had to be repaved. And that's another thing that I would ask an operator is, hey, what's your CapEx budget? And did you raise for it ahead of time? Or are you paying for everything out of cash flow? Because it was $30,000 to redo the whole parking lot. And luckily, with all of our deals, we have hundreds of thousands of dollars in reserves and CapEx. So that was not a big deal. It doesn't change our returns. The money was there, and it was like, okay, we're going to create a nice parking lot, and that adds value. We didn't know it was coming, but that's okay. So it's not necessarily a mistake. It's just one reason why you want to be well capitalized. We had one building with personal money that my partner had in Eastern Washington, where this was before my day, but during COVID, they were converting, and the meter pack on the street blew out. And it was, Eastern Washington has like the cheapest electricity. So he was trying to convert it, but the meter pack actually couldn't support the building. And that's not something that's usually covered in a standard inspection. And then the meter pack was back ordered 3 years because it was COVID. So he had to fight the city to break it into 2 meter packs. And the building was half full for almost a year while they waited, while the city approved that, and then they got the work done, blah, blah, blah. So that's one of those unfortunate surprises in real estate. But again, if you have the right debt and you have 7 to 10 years, it doesn't tank you. It just hurts your returns a little bit. You're not getting cash flow. It's a bummer, but it's not devastating. You're not losing people's money. So those are a few like laws that have that have happened to us. And we've had smaller ones, but I think the biggest thing is just raising your CapEx budget ahead of time. And if you do that, you're prepared when there is an unfortunate surprise. And then obviously getting good insurance too. Like I've seen some operators have $1 million deductibles, and I'm like, what happens if you do need a new roof or something catastrophic? That would be really bad, right? We have very good insurance with low deductibles. And so if there were to be something, we haven't had that happen. If there was to be something large, like, we would be well covered.
How should passive investors think about building wealth in the next decade?
That's a personal decision. There are lots of ways to make money, and I'm not here to say that multifamily Washington real estate is the only way. I think my perspective after being in this has shifted from a net worth goal, although I still think about that, but into a cash flow goal, where I think more people should be thinking, how do I create enough cash flow that I can retire at X age, whatever that age is for you, whatever your goal is. And I have too many clients that come to us that are 50, 60 years old, and they're very wealthy. They're like, I have $10 million in stock and Microsoft and tech stocks and blah, 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 but I can't retire because as soon as I do, I'm just going to be liquidating that stock. And they don't have any real estate and they don't have any cash flow, and they realize too late. They're in a position where they can then start to transition that. But it's, if you had done that from the time you were 30, by the time you were 40 or 50, you wouldn't be in this position where now you're going to have to sell a bunch of stock, pay taxes on it to transition it into real estate. So I would encourage people to think, what is your actual goal? If it's just net worth, then go ahead and chase that and buy crypto and do all these crazy things if you don't care about cash flow. But I think it's more important to say, how do I cover my life? What is my life cost, first of all? And how do I cover that in cash flow? Because as soon as you accomplish that, you are financially free.
That's great advice, Lauren.
Thank you.
That's really well said. So, is there any last thing before we close out, that you would like to say to our listeners?
I think just be intentional with your hard-earned money and just be intentional with your goals. I think it's unfortunate the amount of people that have done really well, that are really very smart, and they didn't have the right wealth manager, or they didn't strategize appropriately, and they should be in a different position than they are. And so I would encourage people to talk to different syndicators. Anyone is welcome to reach out to me, and any questions you have, it can be just an informational to learn about how might real estate investing be a part of my portfolio. Because another piece is taxes, right? And so we are giving our investors tax-free cash flow and also a large amount of depreciation. Now, whether or not they can take that depreciation against active income is between them and their CPA, but you do get to bank it. And that is another piece of real estate, in my opinion, and I think in most people's opinion, is the best tax strategy in terms of investing, and that gets overlooked. If you factored tax benefits into my returns, that we don't do that. Some syndicators do, but they would be different when you look at it from that angle. So wealth is it's not that complicated, but there are different factors that I think people don't think about, and I would encourage people, especially high earners, to think about, am I really doing the best I can do from a tax perspective? Because again, these clients that come to me that have done incredibly well are like, man, if I had known this about real estate back in the day when I was earning X amount, I would be in a very different position. And I think some wealth managers fall down there, where I'm like, these are people that often have had professional advice, and yet still they weren't made aware of things like syndications, because wealth managers don't get paid off of me, right? So the ones that do refer business to me actually have their client's best interest in mind, because they're not being compensated to do that. They're just saying, hey, this is a person that I trust and this is good for you. Unfortunately, there's a lot of people in the game that will not make that recommendation. They'll say, no, real estate is bad, keep it all in stock or put it in a DST or REIT, because they get paid off of it, and those returns are not as good as working with the syndicator. So if you can find someone local or someone that you trust, I think it's worth a conversation. It obviously doesn't have to be me. There's lots of good people out there, depending on what you're looking for. If you're passionate about development and you like a little bit more risk, go find that person. But there's lots of creative ways to make money, and potentially Trump will change the accredited investor thing too, and more people will get access to alternative investments. You do have to do your due diligence on that, but I think that's a good thing to give people access to ways that are more creative and have better returns when it comes to wealth building.
Very good. And if our listeners want to find you and connect with you, they can find you on LinkedIn, right? Under your name, Lauren Rogers.
Lauren Rogers on LinkedIn. Yeah, I would go there. I'm very active on LinkedIn. So also, if you want just more information about my thesis, and I try to not be self-promoting, but generate a lot of informational content for an audience that's maybe newer to investing because my followers are primarily tech people, although that has shifted now into a lot of real estate people. But I do try to make my content digestible for people that might be newer to real estate.
Very good. And we can also check out your website.
Yep, veritasequitypartners.com. You are welcome to go there. I have my podcast there. So if anyone wants to listen to me yap more, they're welcome to do that by going to my website. And then you can subscribe to our newsletter there. Reach out to me directly through the website as well.
Love it. Lauren, thank you so much for being on. It was a wealth of information. You did a great job presenting it to our listeners. And I'm really happy that you were on to share all that with us.
Thank you so much. Yeah, I hope it was helpful, and I appreciate your time and anyone who's listening.
And that's a wrap on today's episode of Pending and Trending. Lauren, thank you so much for being here and for sharing your valuable insight. One of the biggest takeaways from today is that cash flow matters. It's not just about building net worth on paper. It's about creating income that gives you flexibility and real freedom. And before investing passively, make sure you ask the right questions. What's the company's track record? Do they know their market? How is the deal structured? What kind of debt are they using? And how are they protecting investor capital if something unexpected comes up? Those are the kinds of questions that help investors move from guesswork to strategy. If you enjoyed today's episode, be sure to subscribe, leave a review, and share it with somebody who's ready to think differently about wealth building. You can connect with Lauren Rogers and check her out on LinkedIn or visit her website at veritasequitypartners.com. Until next time, your journey matters, and together we unlock possibilities. Thanks for tuning in to Pending and Trending. Remember, generational wealth doesn't happen by accident, it happens by action. If you liked today's episode, share it with a friend, subscribe, and let's keep elevating your journey together.